Okay, so now we look at the models of equilibrium and the income determination. So I'm just from saying that the national income and its components is what we need to look at. So you find that the components of national income can be derived from the composition of how national income is measured. So yesterday we talked about the key measurements of national income being the gross domestic product GDP, the gross national product GNP, and the national income, which is same as the net national product. Okay, the net national income actually. So these are the three measures of national income. We usually use these three key indicators to measure whether the economy is growing. So you will see that now the components of the national income as a whole shall be derived from the parameters that we use when we're measuring GDP, GNP, and NNI. Is that okay?
No.
Mm-hmm. So what you will understand is that most of the times we have the people actually or organization that spend money. They spend money to buy the goods and the services. So always when you spend, it is either you're gaining a service or you're gaining a good. That is the main assumption that we make. So find that we have got the households. These are consumers. They consume. Then we have got the government. The government also participates. Then from the government, we have got the foreigners who come to buy our goods and to whom we do sell or export our goods and services. You're following? So those are some of the participants that we have. So the people who earn wealth, you find that they're categorized into this way. Number one, we have those that labor. They labor to earn wages for for the work they do, number one. And we have those that provide capital. These people that provide capital, they earn interest on the capital that they provide. And you have got those guys that own land. Those you find those people that own land, they earn rent on the land that they provide for economic use. And again, we have entrepreneurs. The entrepreneurs earn profit for the business risks that they undertake. So you find that your people can labor for wages, or they can provide capital and they earn some interest from the capital that they invest in, or they can own land, they get some rent from land. You can have entrepreneurs that will earn profit from the risk that they do undertake. Is that clear?
Yes, please.
Yeah, if that is clear, it's okay. We can continue. So all in all, we can just summarize the entire the entire equation, especially for gross domestic product, GDP, as the consumption that we get from the households, and plus all our investments, plus the government expenditure, whatever the government spends, then plus the exports minus the imports. So X is exports and M is imports. So when we sum up these, we get the gross domestic product, which we did find yesterday. Is that clear?
Yes, it is.
That is clear. We're okay. So you'll understand that now the relationship between GDP and GNP and the national income is in such a way that GDP, okay, GDP minus the net property income from abroad. We have net property income from abroad. So income from abroad, okay, this will give us GNP, okay. And again, from GNP, when you say GNP minus the depreciation or capital consumption, you get you get what is called the net national income, net income, which is called the NI, the national income. So I'll repeat this. I was saying that the way how I've already shown you how we get the GDP, right? You add the consumption, you add the investments, you add the government expenditure, then you add the net exports. Then now what happens is that how do you get the GNP, the gross national product? From GDP, you remove the net factor payments from abroad. Okay, the net factor payment from abroad simply means that money which comes from abroad. Yesterday, when we were trying to define GDP, I said it measures the final value of all the goods and services that are produced within the boundaries of our country. Yes. Then when it comes to GNP, okay, just on GDP, you find that when you're measuring that final value, we don't care of who owns the factor of production. It could be the outsiders or the indigenous people. Then when you're measuring GNP, what happens is we are not just limiting ourselves to our country boundaries. So we also factor in the other worlds. So we are looking at how much we earn as the citizens of our country, okay, both within and outside the country. So there are some people who have got investments within and people who have got investments abroad. They earn capital, they own companies abroad, and whatever they sell services abroad, whatever they earn, as long as they are our people, is what we're going to include in the GNP. You're following, right? So GNP, so what the main difference you find is that GDP does not include the production from abroad, but GNP does include production from our abroad, but it just removes, okay, GNP. We include all production from abroad, but we remove that production which has been done by people who are not indigenous people of the country. So we can get all the production from within Zambia and from abroad, but we're just concentrating on what our people, our own people have produced, not what others have done, okay? So if you are to calculate GNP, we won't consider the companies that are Chinese owned in our country, we won't consider the companies that are US owned, all those that are not owned by Zambians. We don't care at that point when you're dealing with the GNP, okay?
Yes.
Okay, that is clear. Then with the GDP, from GNP, if you remove the capital consumption, which is called depreciation, you know that capital, by the way, capital, those are fixed assets. Most of the times you call them from accounting point of view. The non-current assets lose value, right? They wear out in value. So once you remove from them the value that you think has been lost, the depreciation, you get the national income. Is that clear?
Hello.
So if you want to get the national income, you just say GNP minus depreciation of capital or capital consumption. Is that clear?
Yes, please.
If that is clear, then we can, I think, move on. So now, what you'll find is that we need to, let's consider first the consumption, savings, and investment function before we move to this page that I wanted to move to. So to simplify the analysis, we ignore the government spending, we ignore taxation, we ignore imports, and we ignore exports for the time being, okay? So what happens is that now when we ignore, if we ignore government expenditure, we ignore taxation, we ignore the imports and the exports, what you're doing is that if you ignore government and taxation, you are removing the government component from the circular flow of income. You're following, right? And again, once you remove the imports and the exports, you are removing the other world or the external world, right? So it simply means now what you have an economy, very simplified version, where you don't just have the government and you don't have the external world. Because from the external world, we have the imports and the exports. Is that clear?
Yes.
Okay. If that is clear, so when we ignore the imports and exports, we concentrate on a closed economy. We don't have the external world. I've already said that. So now, when we're given the national income and we are told that it is in equilibrium, okay, when the national income is in equilibrium, what you have is that our national income shall be equal to consumption plus savings, okay? Consumption plus what? Plus savings. So that if you want to calculate for consumption, you can manipulate this equation, bring the savings to the other side of the equation, and have your consumption equal to what? The total income. By the way, Y is income, national income minus what? Savings. You have consumption. Are you following, right?
Yes, I am. So Y stands for income.
Yes,
And then the
Y
C
is
is for
income,
consumption.
and S is savings. So if you remove savings from the national income, you remain with what you consume. Okay?
Okay.
Yeah. So now, observe that we have said that Y is equal to what? To consumption plus savings, isn't it?
Yes.
And at the same time, we can still say Y is equal to consumption plus what? Plus investment. Okay? Because our assumption is that the principle is the amount that you earn, you can either spend or can either invest or save the amount that remains from consumption. When you consume, and once you're done consuming, whatever remains, you can either invest or do what? Or save.
Also,
Yeah. Therefore, it's rational for us to say consumption income can be equal to consumption plus savings. You get that?
yes.
If that is the case, then why we can equate the two equations, because Y is equal to consumption plus savings and Y is equal to consumption plus investment. Then we can rationally say consumption plus savings is equal to consumption plus what? Investments, right?
Yes.
Yes. Then having that, you can see that when you can see that if you have to bring these equations, one of the equations to the other side of the equation, what you will have is consumption plus savings minus what? Minus consumption, right?
Consumption.
Minus the investment equal to 0. Are you following?
Yes, I am.
So that consumption and consumption can cancel, right? Because there's one with positive and with a negative. So you have your savings minus investment equal to 0, so that you can rationally say savings is equal to what? To investment. This is what I was saying. I was saying that whatever you invest is equal to what you save. Did you get that?
Yes, I did.
Yeah, so this is the derivation from. Okay. If that is okay, I don't know if speaking so fast, then I need a break.
I understand.
Okay. If you're understanding, then it's well and good. Let's look at the equilibrium level of national income now. So what we are going to do is to look at the basic elements of the Keynesian model for national income determination equilibrium. So Keynes, okay, the Keynes, those guys, the Keynesians, By the way, what happens, we have got actually about 5 types of economists, groups of economists. So you have to choose where you belong to. The first group of economists existed before 1936. Those guys that existed before 1936, we also call them the classical economists. Okay, the classical economists. With the classical economists believed that the economy can bring itself to the equilibrium even without the government intervention. Those are classical views. The classical economists say, even if the government is not there, okay, the government does not intervene, the market is self-correcting, meaning it brings itself to the equilibrium. No need of the government. That's what they believed. They believed that the economy would control itself via the forces of demand and the forces of supply. But with passage of time after 1936, John Maynard Keynes, an English economist, wrote a book, okay, The General Theory of Employment, Interest, and Money. This guy changed the perception and said, no, we need the government to correct the economy sometimes. Because sometimes you can't just be watching the economy doing whatever it feels doing. So what happens is that you can't just be watching. So the government has to come in bringing equilibrium in the economy. Those are Keynesian economists. The classical guys say, even if, for example, inflation, when the prices are rising, you just have to keep watching. Themselves, they will sort out themselves. That's what they believe. But Keynes said, no, we need the government to quickly come in, okay? Obviously, from other theories, such as the quantity theory of money, that says that there is a positive relationship between money supply and the price levels. So what happens is that if money supply increases, the government increases, that is the central bank. If it increases money supply, even the price levels increase. This is the quantity theory of money. So from that, we know that once the government intervenes in the market, they can control inflation. But without the government, the belief is that inflation cannot just control itself. That's the perception of these guys. I just wanted you to have an overview of what they believe in, the Keynesian economists. Okay. Hello.
Hey, I'm sorry, I muted myself. Yes, I understand.
Okay. So now, the basic idea was that demand and supply analysis could be applied to macroeconomic activities as well as macroeconomics. So aggregate demand means the total demand in the economy. It means total demand in the economy for goods and services. That's aggregate demand. And aggregate supply is the total supply of goods and services in the economy. So the equilibrium point is a point at which aggregate supply is equal to what? Aggregate demand. Is that clear? Then this is a price level that
Will you please come again on that?
when the economy is in equilibrium, aggregate supply and aggregate demand are equal. You have this equilibrium point. At this equilibrium point, this is the price that brings the economy to clear, and this is the quantity that brings the economy to clear. That simply means when whatever is demanded as a whole, then the quantity of goods and services that are demanded are equal to whatever they are being supplied, then we say that the economy is in what? Is in equilibrium. Is that okay?
Yes, okay.
Yeah. Okay, that's okay. It's fine if you are following. Okay. So we bring in the concept of consumption. We talk about consumption a bit. So consumption formula is based on the propensity to consume and the marginal propensity to save. Okay, the consumption. So let me speak like this. Yeah, what we mean is that, you know, how much you consume is dependent on your marginal propensity to consume and your marginal propensity to save. Okay.
Mm-hmm.
So whatever you consume or whatever you save is basically dependent. It's most of the times dependent, or is always dependent on the marginal propensity to consume and the marginal propensity to save, which is just a fraction. So what is marginal propensity to consume? Okay. If there is an increase in total income, okay, some of the extra income will be spent and the rest will be saved. So the proportion, the percentage of additional income is called the marginal propensity to consume. Okay.
Mm-hmm.
If the income increases, okay, some of the extra income you're going to do what? To save. Now, the
Yes.
fraction of additional income is what is called the marginal propensity to save, to consume, sorry. So in short, marginal propensity to consume measures the relationship. I would rephrase it like, it measures the relationship, or it tells us how much we actually consume with an increase in income. I think that's the right way of putting it. Yeah, you can explain it like, when our income, you know that whenever our income increases, even our expenditure grows, right? When
Yes.
people increase in how much they get paid, they even start including other things to their consumption levels. Okay, so there is that additional increase in consumption that is as a result of increase in what? In income, is what is called marginal propensity to consume action. You get that, right? Hello? Hello? Okay, I continue recording. So what you observed is that we had ignored government and the
Yes, we
taxation.
did.
We ignored the exports. We ignored the imports. Okay. So saving and consumption are the only two uses, okay, for our income. Therefore, if that is what we happened, then the marginal propensity to consume plus the marginal propensity to save shall be equal to 1. Did you get that? So if we ignored all these things, then we just know that our income is just used for what? For savings and the
And
consumption.
consumption.
So your income you can either consume or save. That's all you can do. So therefore, some of the fraction of your income will be saved and the other fraction will be what? Consumed. The
Will be
fraction that you
consumed.
consume is what is called the marginal propensity to consume. Then the fraction that you save, yeah, is what you, yes. Okay. Are we together?
Yes, please.
Okay. So therefore, our consumption can be given as autonomous consumption plus the marginal propensity to consume times our income. Did you get that? Okay. So it's same as C is equal to our A plus C by, where our B, okay? Our B is the marginal propensity to do what? to consume, okay? Or it is a percentage, a constant percentage of the income actually that goes for consumption. Are you following? Hello? So what happens is that when you are consuming, consumption is divided into two. There is this one which is called autonomous consumption, okay? Autonomous consumption. And this one is called induced, okay? It is called induced consumption. What is autonomous consumption? Okay, autonomous consumption, this is the consumption that is not influenced by what? By income. Hello? Hello, are you in the meeting? Hello?
Yes, I'm sorry. I had a phone call. I need
Okay.
to put it on the laptop. Otherwise, phone calls just keep taking me out of my concentration. Which I'm understanding myself.
Okay. We continue?
Yes, please.
Okay, I was saying consumption is always divided into two, right? There is what is called the autonomous consumption, this one, and the induced consumption. Autonomous consumption, this,
consumption.
yes. The A is autonomous consumption. The word autonomous simply means independent, like independent consumption. Now, it is independent, it's a consumption that is independent of income, okay? When the income is zero, like this Y is zero, you find that you remain with what? With A. That is, in real life, people cannot stop consuming, even if they don't have income, right? People consume. They can either now start borrowing, even when the production is zero. That's what we're trying to do. They can start borrowing or borrow from relatives or whatever so that they can just consume. That is autonomous consumption. The one that is there when income is zero, when people don't earn, but they consume.
So,
Then there is
this
this
consumption is dependent on income that is not there. When
the
income has
A
not
one.
been earned.
Yes, it is not dependent on the income, on availability of income. Whether you have income. Now, this income that we're talking about is the income that you work for. Okay. Yes, whether you're working or you're not working, you can either borrow or what, but still you will consume. That's the consumption that we mean. But this other fraction, this part, is induced consumption. It's dependent on what? Income. Okay. So this one happens, it's an additional consumption where as your income increases, you also increase what? Consumption. You get. This one is dependent on your income. That's what we're just trying to mean here. Did you get that?
Yes, I do.
So now let's say a person has some monthly income of 800, right? Then the consumption will be 100, right? Plus the 80% of what? Of 800. What is 80%? 80%, the assumption that we make is that this 8% is the marginal propensity to consume. Okay, so let's say a person has got some fixed spending. This is fixed spending that is not dependent on what? On income, 100 kwacha, plus some extra spending equal to 80%. That can be, then it means your consumption will be 100 plus the 80% of this extra income that has increased, right? Your Y, which is 0.80 times the 800, right? That's what you add here. And all you get is 740. So that's what I meant. I was trying to mean that always income consumption is dependent on income. So if your consumption is dependent on income, that is called induced consumption. You can even do this second one, whereas now you have the fixed one. The fixed is 100. Then you're also doing 80% of what the income, your monthly income is 100. So your Y is 100. So you do 80% of what 1,000. So you find that your consumption of what 900. Did you get that?
Please go through that again. When monthly income
okay.
is
I was saying that we are having an example that fixed consumption is 100, right? This is autonomous consumption plus our B, which is the percentage, okay, of the income that you get for consumption, is actually 0.80, right? Which is 80%. 80% of what? Of Y. Okay, your Y is income. So you say 100 plus 0.80 times what? 1,000, the income, the new income that you have, monthly income. So that gives you a 900 as total what? Consumption. Did you get that?
Yes, I do.
Okay. I'll repeat quickly. I was saying there is some consumption that is fixed, right?
Yes.
This is autonomous or fixed consumption. It doesn't depend on income. So we are told that the fixed consumption is what? Is 100 in the question. Okay. Then always once your income increases, you have extra spending that will be equal to what? 80%, meaning extra consumption, additional consumption, which is same as the marginal propensity to consume. Okay, it is 80%. So your B shall be what? 80%. Then your Y is your income. You get that, eh? So to calculate for consumption, you say autonomous consumption 100 plus B, which is 0.80 times your income Y, which is 1,000, and you have a 900 kwacha as your consumption. Okay.
Got it.
Okay. So that's what is there. Am I speeding up, or we are okay? We're good to go?
We are good. We're good to go.
Okay. If we are good to go, let me speak about the concept of the paradox of thrift that most of people talk about in economics. So the paradox of thrift states that an increase in autonomous saving, okay, autonomous saving will lead to a decrease in aggregate demand, thus a decrease in GDP, which will in turn lower total savings. Did you get that? No, you didn't get it.
No, I didn't. Please come again. You said an increase in autonomous savings?
Savings, yes. There are some, we assume that there is some savings now that is not influenced by income. Yes, like you just fix it. I'm gonna be saving. So there is some fixed saving. So an increase in saving will lead to a decrease in aggregate demand. Okay. Aggregate demand is same as output or income if you want. Why? Okay. So if aggregate demand decreases, that will lead to a decrease in what? In output, because they are equal. We agree that aggregate demand is same as the aggregate output time. So if aggregate demand decreases, then even output will decrease. And that will in turn lower savings again. So you find that the thrift is savings increase, but again, they end up what? Coming down at the same time. That's what we mean when the statement is paradoxical. It's arguing itself.
Okay.
You get that?
It's a contra entry.
Yes. So I like it. You have remembered the contra entries. You reminded me of that day. It was bad. Least people were like, Pastor, we want to learn contra entries. And I'm just happy that the people cleared. They passed very well.
I'm excited that I cleared. So thank you so much.
Wow. we are glad to hear that progress. So saving is treated as a virtue, as a virtue by households, okay, as they provide protective umbrella against bad spells. But same is it treated as a vice by the economy, as it regards the process of income generation. Now I'll show you this, what it means. You know what it means is that you guys, as the households, you always want to save, right?
Yes.
You enjoy saving, but the government does not encourage saving, because saving is very, very dangerous to the economy.
That means how is it dangerous to the economy?
Yes, let me speak like an economist trained. So what is there is hello.
Hi, I'm here.
Check. What happens is that when you save, right, you are creating a leakage in the economy. Okay, that's a leakage in the economy. You see that when we increase the when we withdraw the what's this, the cash flow of income, and the cash flow of the flow of income circular flow. Yeah, you know, this accounting background, you always just think of cash flows, but it's not really cash flow. It is circular flow of income. So you see, what happens is that when you save, you are getting money out of what? Out of the economy. You know that, out of the circulation. From the circular flow of income, you learn that income should be circulating, right? It should be used for expenditure. You understand, right? So when people start saving, they are removing the money from the what? From circulation. You're following? The money that has been saved is out of what? Circulation. So the government instead encourages an injection. So let me talk about injections and leakages quickly. Fast forward from the circular flow of income. So you understand that under leakages, you have saving as a leakage or an withdraw from the economy. Then its contra injection is an investment. So instead, the government will encourage what? Investments, not saving.
Okay, I guess
You're
it now.
following, because investments from our equation C plus I plus G, at least investments, they add to the what? To the GDP, to the output, not saving. Are you following?
Yes, I am.
Then again, the government does not encourage imports. You know, imports, again, a leakage in the circular flow. Just look at the circular flow of income. Imports will make money go out of the what? Out of the economy. Like you're removing money. Then most of the times we encourage exporting, which is the contra injection. You're following, right? When you export, you inject in the economy, meaning you're bringing what? Money. Money is coming in the economy. Okay. When you save, you're removing money. Investment, you're bringing in money. Okay. Then taxes. Taxes are what? Are a leakage again. Taxes will remove money from the economy. If the government increases taxes, they are removing the money that should remain with the households, right? And if that money is reduced, what will happen is that there will be a reduced money in the economy. So the government instead increases expenditure, government expenditure. So that's an injection. You've seen the injections and leakages, right? The contra leakages and injections in the circular flow of income. We are concentrating on income, okay, not on goods, but on income. So you see that taxes withdraw income from the economy. If the government increases taxes, then people have less money. Then less money will circulate in the economy. But if the government increases expenditure and reduces taxes, then we'll have more money circulating in the what? in the economy. You okay?
Yes.
Oh, that's good. We are okay if you're good. So most of the times, there is one simple concept that I should talk about quickly as we wind up. It's the concept of the multiplier effect. Okay, the multiplier effect. Okay, so what happens is that when the government spends, maybe it just spends 100 kwacha. It will not just be 100 kwacha in the economy after some time. After a short period of time, that 100 kwacha that the government spent will be even more than that. Will be more than 100 kwacha because of the multiplier effect. Okay, it will not be exact as 100. I mean, the money that has been spent in the economy, like 100, the expenditure itself. There is an aspect of increasing expenditure. Okay.
Yes.
So, I know we need to do an example. Let's do a short example. Let's suppose that this is a closed economy. The marginal propensity to consume is what? MPC. It's 90%, right? That is 0.90. Then that is any additional income to households. 90% is what is consumed, and the 10% is saved. Because we said the marginal propensity to consume plus marginal propensity to save is equal to what? 1, right? Or 100. Yeah, so MPC is that. So if income grows by 200 kwacha, so income changes by what? By 200 kwacha. That is 180 would be spent on consumption and 20 would be saved. Yes. If income increases by 200, how much will be consumed is 90%, 0.90 times 200. So you find that that amount, which is 180, will be consumed. And the rest will be what? Which is 10%, 0.10 times 200 will be what? Will be saved. Did you get that?
Yes.
Yes. So that's how you actually do it. All these other examples are similar. We're talking about the same thing. Okay?
Yes.
Yeah. Yeah. Any question?
No, I'm good. Understood.
If the multiplier, now the multiplier, both the government multiplier to be specific, let's say the government multiplier is equal to 1 over 1 minus the marginal propensity to consume. Okay, which is same as the 1 over marginal propensity to what? To save. Did you get that? That's a multiplier itself, the government multiplier. You know that 1 minus MPC is same as MPS, right?
Yes.
Yes, that's what we've said. We said they are equal to 1, so you can make MPS the subject of the formula. Having established that, you can check and see this. An increase in national income is equal to the initial increase in expenditure. Okay, the initial increase in expenditure over MPS. That's a 200 kwacha divided by the MPS, which is 1, right? Yes. Let me explain clearly. I'm saying that if a government expenditure increases by 200, right? G increases by 200. Then what is the multiplier effect? How will be the multiplier effect? We know that the multiplier is 1 over MPS. Our MPS is 0.1, right? Because MPC is 90%. Yes. So you say G times 1 over MPS, which is same as G times the multiplier, right? G times the multiplier. So G times the multiplier is equal to G times 1 over MPS. 1 over MPS is the multiplier. So you say your G is what? 200 times 1 over 0.1. You followed that? So I was saying that you've seen the multiplier, huh? It's 1 over
Yes, I have.
MPS.
1 over MPS.
MPS. So if we say if the government expenditure increases by 200, so to see how much national income will increase, right? So the formula will be the change in national income Y shall be equal to the change in what? In government expenditure times the multiplier. You're following, eh? So the change in government expenditure, 200 times our multiplier is 1 over 0.10. When you multiply that, you get a what? A 2,000. Did you get that? That is an increase in what? In income. So the question is this: given that MPC equal to 0.9, okay, what will be the total national income if and only if the government expenditure increases by what? By 200 what? Did you get that? That's the question. We have a lot of practical questions around it. I was saying, given that the marginal propensity to consume is 0.9, right? What will be the change in national income if the government expenditure changes by 200? That's the question. So you know that MPC, we can use it to find MPS. Okay, we need that government that has been spent, the government expenditure, we need to be subjected to the multiplier effect. Okay. I've said that the change in income is equal to the change in government expenditure times the multiplier. So the multiplier is 1 over what? MPS, which is 0.1. Okay. So you say 200 times 0.1. That gives us what? 2,000. Which means our national income of what? Will be 2,000. Okay?
Okay.
Did you get that one?
Yes, I did.
Okay. So again, which means it might be the same thing. If the question is phrased, if the marginal propensity to consume is 80%, meaning MPC, if MPC is 0.8 or 80%, then the marginal propensity to save will be 20%, right? Then the question is, what will be the multiplier? Yes. You're following there how we are phrasing the question. The question is, what is the multiplier if the marginal propensity to consume is 0.80? What will be the multiplier? So the multiplier is equal to 1 over MPS, right? Which will be equal to 1 over 0.2. And that gives you what? 5. So your multiplier is what? Is 5. Did you get that?
Yes.
So your multiplier is 5. So if you already have a multiplier, then you ask it now, what will be the change in what? In income if maybe investment increased by 50 kwacha. So you say the change in investment, which is 50 kwacha, times what? The multiplier, 5. By the way, the government multiplier and the investment multiplier, they are the same. It's 1 over MPS bonds. Okay. So if you're asking that, what will be the change in what? In income, if your investment increased by 100 kwacha, and your multiplier, you have already calculated it to be 5. So you just send the change in investment. The change in investment is what? What's the change in investment? It's 100 times the multiplier, which is 5. And that gives us 500. So our national income will become what? 500.
Okay.
Okay. So the change in what? The change in output, the change in income is what? 500. Okay.
500.
You are following, right?
Yes, I am.
Okay. If you're following, at least you're almost getting there. I'm more getting better, or you're almost getting there where we want you to reach very soon. Do you have any question?
No, I'm okay.
You're okay. So yeah. So actually from here now, what you can see is that whatever we're trying to do is just to bring in the government into play, because at first there was no government. Remember the economy that you had was just a food sector economy. So now we introduce the government. Now we know that whatever government spends, it has got the multiplier effect. Okay, so that's why I introduced the concept of the multiplier. So otherwise there is nothing much. Okay.
Yeah.
All right. So now, if we introduce the taxes, I just want to give you the tax multiplier as well, because these are adjustments that you are making in the national income account. You can also have the government spending. So you see that even the taxes, they have got what? Multiplier. Now, tax multiplier will be equal to, okay, negative MPC over MPS. Okay, this is the formula for the tax multiplier. Whereas the government multiplier or the investment multiplier is the same kind, is equal to 1 over MPS. These are multipliers. So if you are asking that, what will be the change in income, for example, what will be the change? Let's have the MPS. Let's have the MPC. MPC 80%, right? 0.80. Then our MPS will be what? What about MPS? If our MPC is 80, 0.8.
MPS is 20.
Yes, 0.2. Yes. So the question is that if MPC is 0.80, right? Then the question is that what will be the national income if the government increases tax by what? By 50 million. Did you get that? So we want to get the change in what? Change in income as a result of change in what? In government tax. Now listen, change in what? In tax times the multiplier, tax multiplier. That's how you find it. Okay. So you say change in income. So income will change by change in tax times the multiplier. Okay. So we can calculate the multiplier first, the tax multiplier, of course. It is MPC, which is 0.80 divided by what? 0.20 negative. Tax always has got the negative effect. What do you get? What would be the tax multiplier?
That would be negative. Yes, it's 80. So the negative is only for the MPC, right?
Yeah, it will be for everything. Okay, it will be for everything. No, there is just one negative, but the answer always, tax multiplier is always negative.
Oh, okay.
What will be the multiplier?
So I'm supposed to get negative. Am I supposed to get -4?
-4, okay. So this is the multiplier. The tax multiplier is -4. So if the government increases tax by 50 million, so what will be the change in what? In income. So your income change in income will be equal to change in tax. What is the change in income? In tax is 50, right? 50 million times negative what?
-4.
-4. Observe what happens. You have negative 200 million subtracted from what? From income. You've seen that, right? So national income decreases if you increase what? Tax. I told you that taxes are a what? I withdraw in the economy. This is what we are verifying now. They are a leakage. So if you increase taxes, you are withdrawing, the income will start reducing. So we've seen that income has decreased by what? By 200 because of the increase in what? In taxes.
Because of the increase in taxes.
So now you pay attention when it comes to taxes, the movement of taxes. If they say that tax has increased by what? By whatever number, then it means this number here will be positive, okay? That's increase. Change in tax will be positive, okay? But if they say, if the government decreases tax, then you put a negative here, okay? Like change in tax will be negative, it is a decrease. So it will be negative times the negative from the multiplier, it will give you a positive, right? Which means that it will be an increase. So you mean that income will do what? Will increase by 200 if the government reduced taxes by what? By 50 million.
By 50 million.
So if the government reduces tax, then the output, the national income grows, usually. It grows. But if the government increases taxes, what happens to the national income? It reduces. This is what I was just trying to verify. Did you get that?
Yes, I have.
Yes. So those are some of the few adjustments that the government brings in now. Because the government controls taxes, it also controls what? The government controls taxes and the government controls the expenditure. So you find that taxes has got multiplier. The government expenditure itself also has what? Has a multiplier. And the taxes and the government expenditure, they have an influence to what? To the output, which is why the national income is affected by this. So now, the concept of when you're trying to study the way how the government adjusts taxes, okay, and they adjust government expenditure, how the government controls taxes and government expenditure, that is called the fiscal policy. You're relating, right?
Yes, I am.
That's the fiscal policy now. So the government has come in, it is controlling how much it is raising as taxes and how much it is spending as its expenditure. That is the fiscal policy now, the decision by the government deciding on how much to spend, how much to do what, to raise again as revenue taxes. Okay, that's the fiscal policy. But when the government through the central bank is deciding how much money should be supplied in the economy, that's money supply. That is called the monetary policy. Okay, fiscal policy is the government controlling taxes and the government expenditure. But monetary policy is the actions of the central bank money supply, okay, controlling money supply, increasing or decreasing money supply. When the central bank says that there is little money in the economy, we don't have a lot of money, what happens is that the government through the central bank will increase money supply. Then again, if it sees that there is too much money, that is dangerous to the economy, it reduces what? Money supply. We'll talk about that under monetary approach or under monetary economics on how government now, how the central bank increases and how it reduces what? Money supply. Okay? This is the circular flow that I was talking about yesterday. You've seen it, eh?
Yes, I have.
Yeah. So it's basically, I think it doesn't need explanation further. I've already said that investment is an injection, eh, to the economy. You've seen exports, they're bringing in income to the economy, but savings are a leakage. You've seen, and the imports, those they are removing money from the economy. That's what we meant. Okay. Did you get that?
Yes, I did.
You got that summary. So we are ending very soon, and you are tired already, but at least you've listened, paid attention. Okay. So when the government has been introduced, then the equation built as C plus I plus C, the government expenditure. Remember, we had just C plus I, right? We just had C plus I. Yes. So now, follow nice how we are deriving. So C plus C, I plus G is total government expenditure. And we know that this will be equal to Y. And again, our Y shall be equal to C plus C, savings plus what? Taxes. Because we assume that whatever government spends, it just raises it through what? Through taxes. You're following, eh? Did you get that? So government, government expenditure is equal to what? To taxes. Are you following?
Yes.
Yes, you are. And so when you do that, you can see that C and C cancels, you remain with I plus G equal to what? Savings plus what? Taxes. Okay. If you are to bring all these equations to the same side of the equation, like how we had done previously, that's what you remain with. C and C will cancel. Okay. So again, what will happen is that if you get all these to the other side of the equation, the government minus taxes shall be equal to what? Our savings minus what? Investments. We collect them like that. So government minus taxes. Government, whatever government spends minus what it earns shall be equal to whatever we save minus what we invest. Okay, that is an identity. Okay, this is an identity for leakages and injections. So it's for leakages and injections. You know that when the government increases the government expenditure, then taxes have to what? Reduce. They don't move in the same direction. Okay. You're following, right? So whenever the government expenditure is greater than taxes, then we have budget what? Deficit. Whatever government spends is more than what it raises. When government spends more than what it makes, because we assume that the government makes money through taxes, right? So if the government expenditure is greater than taxes, then the government has a deficit. Okay. But again, if the government, so again, but if the government expenditure is less than what? Taxes, then we have a what? A surplus. Okay. This is a what? A deficit. But if G is equal to T, then we have what? We have a balanced budget. Okay. It's a balanced budget. Did you get that?
Yes, I did.
Okay. So actually, this is what I was just trying to build up, and it's basically the same thing. It's only that if you've observed, now we're trying to build up all the components slowly, and just trying to add them. But otherwise, it's the same thing that I talked about. Change in taxi times MPC over MPS. I've already talked about this, isn't it?
Yes, I have.
Yes, the change in income is equal to change in income is equal to negative change in what? Taxi times MPC over MPS. I think I just talked about this previously. So I'd gone after the slides already. So it's the same thing So the balanced budget, I said, it is actually equal to what? It's equal to 1. Yeah. So when you open the economy, you include the exports and the imports. Okay. When you start exporting and importing, it means you include the what? The external sector or the foreign sector. So from yes, when you include the foreign sector, it means that you start importing and exporting. So at that point, you see that the circular flow of income changes. It has got 4 sectors, like the way how I was already explaining this yesterday, right?
Yeah.
Yeah.
Yes, sir.
And then once we introduce the 4th sector, now you see that the equation for national income changes, right? National income will include all the 4 components: C plus I plus G, the government, again plus the external world, which is the external sector, the foreign world. So that's what usually happens. So do I have any questions?
No questions.
There is already a summary here again. Since I'd gone before the slides, the
You know these things too well.
Injections are here. You know, injections are what? Investment plus government plus exports. Then leakages or withdrawals are savings, taxes, and the imports. They are both leakages. They are what? They are a withdrawal from the economy. Okay?
Yes,
otherwise, that's what is there actually. So we have to ask for questions now.